One of the best ways to actually gauge the health of the U.S. economy is by looking at the housing market, which is why I talk so much about these two subjects in tandem, because they both feed off of each other. You can't have a healthy housing market without a healthy economy, and you're not going to have a healthy economy without a healthy housing market. Both of these things are crucial in keeping a balance in order for things to work smoothly. And there are some specific warning signs that we can look at with the housing market that might mean the economy is in trouble. One of the big ones is FHA delinquency rates, okay? Because typically FHA borrowers put down only 3.5%. Actually, that's part of the program, so that's all you're gonna be putting down. And people that use FHA are typically lower income individuals that don't have a lot of money for a down payment, and FHA will actually give you a loan if with a credit score as bad as 580. So no traditional or conventional lender will ever do that, guys. The minimum credit score for a traditional loan is 620. So FHA not only will give people that don't have money and don't have a good credit score a loan, but also if they have higher debt to income ratios a loan. In fact, I think the highest debt to income ratio that they will go to is up to like 55% or something like that, which is just completely absurd because nobody in that financial position should be buying a house, but the government will lend you the money. What we're starting to see happen, which is not really a huge surprise, is more people that have FHA mortgages go delinquent and miss their mortgage payments. Because what's happening is lower income people who decided to buy a house over the past couple years are now starting to face mounting financial stress in their lives, which leads to missed mortgage payments. Now, the national delinquency rate went up 5 basis points in February to 3.53%, according to ICE. And that's up 19 basis points from a year ago, but it's still below 32 basis points where it was before the pandemic started in 2020. So from that measure alone, people will look at it and say, well, there's nothing to see here. People are still in a better position than they were 5 years ago. And that's only true when you look at all categories. But when you narrow it down to FHA, it becomes a bigger issue. Because take a look at this. There was 131,000 additional mortgage delinquencies year over year for 2025, right? 90% of those delinquencies are FHA loans, guys. And that's despite the fact that FHA loans only make up about 15% of all active mortgages. So FHA is a pretty low percentage of mortgages out there right now, but 90% of the delinquencies are from FHA. That is a huge warning sign of what's happening right now in the housing market and how that's going to affect the economy in the near future. Now, this isn't saying that all of these FHA delinquencies is going to trigger some massive economic crash. I think we're headed towards that even without FHA delinquencies. But what it shows you is how people on the lower end of the spectrum are running out of money. And it turns out that a lot of the same lending mistakes were made during the pandemic as we saw during the GFC. A lot of people who really were not in the position to get a loan for a house got one anyways, and now the consequences of that are starting to rear its head 5 years later. And to be sure, this is an income problem because people who have a higher income right now and have a traditional conventional mortgage are not seeing anywhere near the amount of delinquencies as FHA borrowers. So that tells you that people who probably should have never bought a house to begin with, probably never should have got that loan, are the ones who are in trouble, which is not a huge surprise because that's exactly what we saw happen back in 2008. But here's the thing, if the economy's headed for trouble, it's these FHA borrowers who are signaling it first. They are the first leading indicator. They are the canary in the coal mine because as the economy gets worse, it starts from the bottom up. Right? People who have the least amount of available cash and the least amount of safety nets to fall back on are the ones that start missing payments first. And then as more people get laid off and as things get worse and business slows down, then that slowly starts creeping up the income ladder. And of course, delinquencies on payments are a precursor to foreclosures. And in February of 2025, foreclosure filings actually rose 5% from the previous month, according to data from Adam. And ICE reported that foreclosure starts were up 34% in February as compared to 1 year ago. And They're saying this is because of the end of the pause on foreclosures on loans backed by the VA. And some people were asking me, have I heard anything about this? Because as of the beginning of this year, they were supposed to move forward with the VA foreclosures that were on moratorium since the middle of last year. Well, apparently that seems like it's starting to happen now, but you don't ever hear anything about this. Even when you try to look this up, you don't find any information, guys, which is kind of crazy because this is all stuff that we need to know about, but they keep that stuff under wraps. They don't want people to know that, yeah, they're finally foreclosing on people with VA loans. You know, we've talked a lot on this channel about property taxes and how overassessed everyone is in the country right now. And there's a very high probability that you are probably paying more in property taxes because your property tax assessment is too high. And that's where today's video sponsor, Ownwell, comes in. Especially in Texas right now, guys. Texas is literally one of the highest property tax states in the country in terms of the dollar amounts that people pay. Texas homeowners receive their annual tax assessments between March and April from their local appraisal districts. And these assessed values are always highly overinflated due to outdated ways of valuating properties. So if you are a homeowner in Texas, you have until May 15th of 2025 to sign up at ownwell.com/Michael Bordenero to confirm your 2025 appeal. Missing this deadline means that you will be locked into potentially higher property taxes for at least another year. And what Ownwell does is they handle the entire property tax protest process on your behalf, and the service is 100% risk-free because if they are not able to get your taxes lowered, you pay nothing. In fact, Ownwell has helped 86% of its customers secure property tax reductions, and the average savings per homeowner is about $1,100, so it's not bad. So if you own your home, go to ownwell.com/Michael Bordenero and find out how much Ownwell can save you today risk-free. And once you're enrolled, Ownwell takes care of the rest. You don't have to do anything else. Make sure you go and check out and sign up with Ownwell today. And another thing that's happening right now behind the scenes in the housing market that could potentially get people into even more trouble are all of the shenanigans going on with refinances and lenders offering teaser rates. Because I've seen several stories this week talking about things like this. Here's a guy who has a 7.25% mortgage rate, and his lender just offered him a teaser rate of 6.2%, but he has to switch from a fixed rate mortgage to a 5/1 ARM, which is a 5-year adjustable rate mortgage. This means that his payments will be fixed for the first 5 years at that 6.2%, but after the 5 years is finished, then his interest rate on his loan is going to adjust to whatever the current market rate is. Now this guy's 30 years old and he's living in a starter home, and he says his career is going well and he makes an above average income, and he expects to get regular bumps in pay as he climbs the corporate ladder. So a lot of people, especially lenders, would say this guy is ripe for somebody who we can hit with an adjustable rate mortgage. And the thinking behind this of why they say, well, we can hit this guy with an adjustable rate mortgage is this. Because these type of loans are usually suited to people who plan to move or pay off their mortgage by the end of the fixed period. They're also suited for people who believe interest rates will go down, but also are willing to take some risk. And they also are people who expect their income will increase enough to accommodate the potentially higher payments that occur later. So essentially, you're taking a bet. You are taking a bet when you do an adjustable rate mortgage. You are betting that rates are going to go down. You are betting that you're going to move before your rate adjusts, or you're betting that you're going to earn substantially more money to cover a higher mortgage payment in the future. All of those things are a bet, which I don't think people should be betting. That's not really a smart thing to do. Unless you know for certain one of those three things is going to happen, it's a bet. So the reason why they target people like this is a younger guy in a starter home. So they say, well, he's likely to move in the next few years before that 5 years is even up. That's the first thing. Also, he's making above average income, he says. So chances are he's going to be able to make a lot more money over the next 5 years. So even if he doesn't move and his payment goes up, he'll be able to afford it. But even so, this guy is being smart and saying, you know what? I'm not really comfortable with the idea that my payments might become potentially larger in the future, especially with the uncertainty of the current economic outlook. The reality is nobody knows where interest rates are going to go. If anybody remembers, like literally 2 years ago, they were predicting that by the end of 2023, that we would see interest rates in, the low fives, guys, or the mid fives. Where are we at right now? We are still in the high sixes. So they were so wrong about where we would be, especially the timeline of how long it would take to get there. We are still now a year and a half later, and nothing like that has occurred. And here's the thing, with all the uncertainty that everybody's facing right now, it results in lower spending. Lower consumer spending equals slower economic growth, which equals more job cuts, it equals pay cuts, it equals things that people don't want to see happen, and basically all the things that we see happen during a recession. We also are very likely heading into a period of stagflation right now, where economic growth is low and inflation is high. And during this time frame, there's really nothing that the Fed can do to try to get us out of it like they typically try to do. So this guy was smart and he decided not to take that deal. And honestly, he wouldn't be saving a whole lot because he's going down 1% on his mortgage rate. So is it going to save him some money? Yeah, a few $100s a month, but we're not talking life-changing money. And if he can easily afford the payment he has right now, he'd be better off keeping it, especially with how uncertain everything is. Refinancing is only going to make sense when you're going to see a substantially lower payment. We're talking saving $600, $700, $1,000 a month. Then it could be worth it. But not if you're gambling and you're going to an adjustable rate mortgage, not knowing what the future holds. And another way they're trying to get homeowners in trouble right now is with a similar situation with HELOCs, okay? There's another story that came out saying that HELOCs have dropped to their 2-year low at 8% right now, and they're trying to get everybody into one of these. So your lender's either going to be trying to refinance you right now, or they're going to be trying to get you to take out a home equity loan or a home equity line of credit, because lenders are hurting just as much as the real estate business, because if no one's buying homes, a significant chunk of their business has essentially disappeared. They say the average rate on a $30,000 HELOC this week is about 8%, which is the lowest level that it's been since 2023. Yeah, well, who cares, guys? Nobody should be taking one of these out right now because, number one, that's subject to change. HELOCs can go up with the market, so if interest rates decide to skyrocket all of a sudden, well, guess what? So does the rate on your HELOC, number one. So you're gambling once again with that. And number two, if you need a HELOC, then you don't have the money for something. There's a reason people take this money. They don't just take it just to take it. Nobody's voluntarily paying 8% interest on a loan. If people take a HELOC, it's because they need that money for something, which means chances are you can't afford it. All these lenders are saying, well, look how much it's come down. It's probably going to continue coming down in the months and years ahead. We expect rates to continue coming down, especially if the Fed cuts rates more. Like anybody who's been paying attention, the rates did not come down once the Fed cut interest rates. In fact, interest rates on mortgages went up. The thing that's been making the interest rates come down now is the fact that a lot of investors are piling into US Treasuries out of fear of the falling stock market. And so the more people that buy Treasuries, the lower the yields and the lower the interest rates on those become, because there's a higher demand for them. And that's what influences mortgage rates. Mortgage rates are directly tied to what the 10-year Treasury is doing. But the reason these rates on HELOCs are coming down is also something sinister that people need to be aware of, okay? It's number one, lender competition. Banks and mortgage companies right now are competing to attract people for these type of loans because it's really the only type of business out there right now since home buying is in the toilet. That and refinancing. So they are really trying to kill each other over getting that HELOC business, getting that home equity business, getting that refi business. And they're also banking on the fact that interest rates are going to continue going down. These lenders themselves are also taking a bet that interest rates are going to come down. And here's what these lenders are trying to do. They are trying to attract applicants with low for a limited time loan terms, okay? So they're trying to draw you in with the candy, right? And as soon as you start getting addicted to it, they take it away. That's how this type of loan works. So you really don't want that. I would always advocate for people to go for stability over anything else, especially with something as expensive and as important as a home purchase. You can do whatever you want. That's just my opinion, guys. Some people know exactly what they're doing, and there are certain cases where getting an adjustable rate mortgage or taking a HELOC might make sense, but just know that if you don't know exactly what you're doing, you're essentially gambling with your home. Because if anything goes wrong, they are going to take that home from you, and you are going to lose everything you've invested into it, and you're going to be back to being a renter or possibly even worse. Now, one other thing I want to talk about is a story that I brought up a while back when this first came out, which was the condo blacklist. And a new story just came out about this recently that I want to follow up on. Because what this is it's a secret list that Fannie Mae has behind the scenes on a bunch of condos throughout the country where they will essentially not give a loan on. So it doesn't mean you can't get financing at all. It just means you're not going to be able to get a conventional loan, and you're going to be forced to get a more expensive unconventional loan. And the reason why any of these buildings in particular find themselves on the Fannie Mae blacklist are due to one of two things. They either have insufficient insurance, or they have critical building repairs that have yet to be made, and so they're not going to write a loan in a building that could end up being evacuated, like I've showed you around here in Miami. Like, there are buildings here that have been evacuated years ago and have never recovered, guys. What's happening to them? Nobody knows. As it stands right now, there are about 5,175 buildings throughout the United States that are on Fannie Mae's blacklist, and unfortunately, they don't make it public which buildings are on this list and what's wrong with the property. They only just deny the loan after you go and make the application for it. So people should start keeping track on their own. Like, for example, there was a place in California in this story that was on this condo blacklist because the deal fell apart at the last minute. So people should be keeping track of that stuff now in order to start making our own blacklist, so we know which buildings are financeable and which ones aren't. But there is a law firm in Boston that claims that they have access to the list, and they gave the Wall Street Journal some data about this. And take a look at this chart right here. These are the 10 states with the most condo projects blacklisted by Fannie Mae, and by far Florida takes the cake here at almost 1,500, and California is right behind them at number 2. And you have Colorado, Hawaii, Texas, Georgia, New Jersey, South Carolina, Illinois, New York. Obviously, they're in other states too. Those are just the top 10. Here's the thing, guys. Not so long ago, there was really no condo blacklist at all, because the requirements have been stepped up substantially ever since the building collapsed here in Surfside a few years ago. And the main thing, which is insurance and repairs, those are what they're basically putting people on the blacklist for, also never used to be such a big issue like it is today. Here's an example scenario of how this played out for a guy in Texas, okay? Here's a guy in Dallas, Texas. He wanted to sell his condo last year, and he found out that the neighbor's sale had fallen through, and he ended up selling the unit for cash at a lower price. So he initially was trying to get $239,000 for the place, ended up having to settle for $170,000. So pretty substantial discount. We're talking, $70,000 off the list price. But even though he was able to accept a much lower price, the buyer's loan was still denied because the condo association's insurance policy didn't provide replacement cost value for some of the amenities, including the pool. So that was enough to put this building on the blacklist. Now, the buyer ended up finding another lender that was willing to make the loan, but you see, that's how this situation can get sticky. This buyer now is probably going to be paying a considerably higher interest rate with less favorable terms on their loan. And the other thing to look at here is insurance companies have substantially raised their rates, especially on condos, especially on older condos, over the past couple of years, making all of this full coverage maybe unobtainable now, which means more of these condos are not going to fall into the category of being able to be financed by Fannie Mae. A lot of condos are already trying to find ways to cut their costs, and one of the ways they're doing this is kind of foregoing as much insurance coverage as they would initially like to have, because this is an easy way to lower everybody's HOA fee. For example, there's a condo in California, in Los Angeles, that was able to dodge the wildfires that we had a couple of months ago over there, but its homeowners association insurance was recently quoted $2.6 million a year for a Fannie Mae compliant policy, which is over 10 times more expensive than their current policy. So if this is the case, we're going to see a lot more condos being blacklisted just because of insurance alone. Even if there's nothing wrong with the complex in terms of repair issues, insurance is going to be the deal breaker. And the saddest part about that is a lot of this insurance is a scam anyways, guys. They're charging you exorbitant rates to be covered. These insurance companies have already been caught time and time again committing fraud and overcharging their customers and underpaying claims, but yet Fannie Mae is still considering these guys the golden standard for who gets a loan and who doesn't. And get this, in order for this condo in Los Angeles to comply and actually have the proper insurance, their current HOA fee is $570 a month. It would have to go up to $1,100 a month, basically double what it is right now, just for everybody to have this insurance, guys, just to make the building not on the Fannie Mae blacklist. So in one way or another, people are going to lose. You're either going to lose by having to sell your property to a cash-only buyer or a lender that is willing to make the loan, which means that buyer is going to want a significant discount. You're going to lose on the sale end, or you're going to lose on the monthly fee end when it comes to paying your monthly HOA fee. You can't have it both ways, unfortunately. So on the one hand, you have people who are all for this and saying, well, these insurance requirements are strict because if the complex suffers a total disaster and you need to rebuild, then the insurance will cover it, right? They will have sufficient insurance to cover that rebuild. But on the other hand, people are saying this is going to destroy the real estate market. It's going to make it too unaffordable to buy these places, especially it's first-time home buyers and people who are lower income that tend to buy condos because they are more affordable. And this is going to make it so that no one can buy these properties anymore unless you have cash. So I don't know what's the right move on this. You know, all I do know is that insurance companies can't be trusted. They've already proven that over the past couple of years, especially with the 2024 hurricane season and how much they were scamming their customers here in Florida. And so basing the entire qualification process around these companies that have been proven to be scamming people, I don't think is the right thing to do. So I think they need to take a different approach. What it is, I don't know, but you let me know down in the comments what you think. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.